Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go and rip through Twitter, see what people are sharing on social media. I'm going to interject my financial opinions as we go. It's going to be wealth building, commodity markets, and or financial markets that I generally follow. So let's dive in. Let's see what people are talking about. And if you want to follow me at Fighting_Finance, and if you want to join our community, finding-value.com, that's where I go over individual companies and more in-depth sector analysis for you guys and can answer your questions. So the U.S. is currently in a recession, according to this guy. It just hasn't been announced yet. NBER formally defines recession periods after the fact. An increasingly political organization, they will probably wait until after the November 2024 election to declare this one. So let me move this back in. There we go. Year-over-year change in conference LEI index. So what we're looking at here, let me move this over. There we go. There we go. Up and down, up and down. There's your recessions as we go below. Perhaps we're already in a recession. And the thing that's kind of weird and the way that they measure some of this stuff is a little bit funky. I mean, here's something that's a little bit funky. We created all this money, Powell did, in the system to avoid a recession in 2020 or to dampen the recession. They overpunch it. You know, they punched this thing pretty hard. We got a lot of inflation. And then they panic in the opposite direction. And we go all the way back down into this level down here in the leading economic indicator index. And I just look at this and I'm like, why would you not? I mean, why would you pump the system with that much money to begin with? Number one. Number two, why don't you slowly bring the money supply down and slowly bring up interest rates and not print as much money and not panic during these time frames? Wouldn't you get a nice steady movement? Now, the only thing I can think of is that he is trying to create volatility in the market for maybe his boys or maybe for the banks or someone to try to gain something from it. I don't know why he would do what he's doing, and maybe there's something that I don't know behind the scenes where if they get anywhere near a deflationary problem, they just pump the system like no other. Because we have so much debt, the money in the system, when the liquidity dries up, you could have a debt problem, and they probably don't want that to occur. So we may already be in a recession. They just haven't declared it yet. And perhaps the inflation is going to be roughly right where it's at. So it'll be a stagflation type of environment. And he's just waiting for the right time to hit the inflate button again, the stimulus button, and when to lower interest rates. It says the U.S. Treasury is expected to borrow more than $1 trillion via short-dated T-bills by the end of 2023. The end of 2023, that's only 2 months. As the government looks to build its cash reserves per fortune. Yeah, let's just keep borrowing money, boys. The percentage of bears in the latest AAII sentiment poll moved above 50%. The highest level of the year and above 96% of historical readings. Now this is a little bit interesting. So we're at 50.28%, which is in the 96th percentile compared to history of the sentiment being bearish. If that's the case, guys, I mean, we have a high likelihood of going higher, not lower. Generally, when your sentiment is this poor, it's actually a good time to be looking for potential investments. I'm sure after 1990, you can see this was very poor. That's exactly when you wanted to buy, was around a little after 1990, and that rocketed back up. The other one here was 2008, would have been a really good time to buy at the bottom here in 08, 09, and this rocketed back down. And we're at a very high level. Here's 2020, just after the COVID crash. That was 50.28% here. I mean, we're at a pretty negative sentiment at this time, which is generally good for buying. This man was arguably the most learned man in economical history. Economical, that sounds weird. Of the 20th century. It says any hint of a recession causes the government to panic and turn on the inflationary taps once again. Murray Rothbard. Well, yeah, that's all they're going to do, guys. So we've got real big negative sentiment. We've got the year-over-year change in Conference Board LEI index, which is actually at a pretty low level compared to everything else in history. Does it have, no, oh, the dates are in the middle there. I was looking at the dates at the bottom, like, oh, they're up here. 1991, 92, bottom. Early 80s, that would have been a good time to buy stocks. Same with here. This would have been a really good time to buy all your inflationary assets in bottom of 02, 01, 02. And this could be the same type of scenario as 01, 02. And I know some people ask me on the website, they're like, where do we think we are? And when I look at where housing starts are at, when I look at the cycle of the rate increases and all that stuff, how the housing market slowed down, I point to this 01, 02 timeframe. I think that's where we're at. Now we just need to lower the interest rates. When he lowers the interest rates, hits the stimulus button, I think we're going to kick off another inflationary cycle. We're going to get more bank lending. I think that the low inventory and the unaffordability of the housing market is going to allow the affordability to get better with the lowering of interest rates, and it's just going to kick off lending. I think right now we're in a stimulus overhang or a stimulus hangover, however you want to say it. So we're in stimulus hangover 1. I'm sure we'll have a stimulus hangover 2. It'll be a new movie coming out after they re-stimulate again. So that is something to watch for is lowering of rates, yield curve control, and more stimulus. The U.S. Treasury, okay, I already went through that. Remember, there are no day traders on the Forbes 400 list. Learn to be content holding and doing nothing. It says, don't bother finding the next multi-bagger if you aren't going to develop the conviction to hold it. That is extremely important if you're trying to invest. Guys, there's no one who's that rich, like way up there, who's a day trader. What does that tell you? And again, if you're trying to find a multi-bagger, you're going to have to be able to hold through some pretty crappy pullbacks. I've seen my pullbacks in my account, and it's been, your account goes up and down a lot. I'll just say that. I've had some of my largest holdings pull back 50%, and they've pulled back pretty big multiple of times. It feels great when you see your account value massively higher, and then it feels like you got kicked in the nuts when your account goes down 30, 40, 50%, and it's some of your largest holdings. And if your largest holdings are all in the same sector, they generally do it all at the same time. So it is possible that you get a portfolio that goes up and down quite a bit. Now, I know some people are going to say, well, let's put some trading things in here and hedge the portfolio and do all this stuff. Guys, I'm unleveraged. I don't have to do that, and just ride it. Ride the thing up and down. Coming on down, here's Cullen. This is one of the more interesting data points I've seen recently. When long-term unemployment rises by 15% year over year, we are either in a recession or nearing a recession 100% of the time. Is this time different? If you think so, why? This is long-term unemployed, and you can see we went from a very low level up quite a bit, over 15%. So perhaps we are in a recession right now, and things are already slowing down, and we just haven't really reported it all. And now would not be the time to panic. The time to panic would be when you're all the way down here and it's turning. But and I don't really panic. It just doesn't matter to me. But long-term unemployed, it is going up. It does match other recessionary calls that people have, and we very well could be slowing down already. And maybe we have a little bit more to slow down. I don't know. And then it will depend on what the Federal Reserve is going to do. Are they going to lower interest rates? Are they going to do what? Do what? In my opinion, interest rates are at a level that prices the housing market at an unaffordable level. We've seen sales volumes drop dramatically. That's bad for everyone who's related to real estate, I guess, because they make all their money off of the volume of sales. House prices haven't really gone down, if at all, depending on where you are located. Some places they've gone down some, others they've gone up a lot. And I think the affordability is having an impact. It's slowing down sales volumes, but we still don't have inventory. We're not in a hyper supply phase. My favorite leading recession indicator is getting more attention here. So here's another one. Temporary help services category in non-farm payrolls. And it is declining. So all that QT that they're doing is slowing things down. We've got a video there from NARF. Pinky in the Brain, guys. That's where it's from. Pinky in the Brain. Charlie says, the worst performing areas of the equity market in 2022, NASDAQ Tech Growth, have been the best performers thus far in 2023. And the best performers from 2022, energy, value, equal weight, have been the worst, which they're slightly higher. So that is the case. NASDAQ, Russell, S&P, they've outperformed in 2023 compared to the other ones. But if you were to look at the last 2 years, it is by far the energy sector that's been the best performer if you were to average these two together. If you're down 32% and you go up 39%, let me do the math on that off the top of my head. So if you've got 100 and you're down, so then you're, what was that, 76? Let's just say 68%. So you went down to 68. Sorry, you go down to 68 and then you multiply it by 1.393. So you're not quite at parity over the past 2 years. You're still down because you went down on a larger amount, 32%, and then you went back up 39% on a smaller amount of money. So you're still below that amount. Here, you are massively higher compared to any of these other options. You are killing the market. So even though we were slow, going up 0.6% on XLE, and believe me, I'm in stuff that's got a lot more leverage than both of these. 2022 and 2023, energy has been by far the better thing. We've been consolidating the beginning portion of this year. And a lot of the smaller guys have broken to the upside. But I do think that the recessionary fears and or the reality of a recession, or maybe we're already in a recession, however you want to say it, is having an impact on oil price. But again, we're going to have to wait and see what the Federal Reserve does and their response to a slowdown in the market. I remain a bull on the energy sector specifically versus all of these other asset classes over here. It's going to outperform continually, I think, over the next 3, 4, however many more years we've got in this bull market. And energy generally does incredibly well under highly inflationary environments. And what I think is going to happen is we're going to get a slowdown. We can obviously see the slowdowns impacting energy. And we're getting these recessionary indicators telling us, maybe we're already in a slowdown. And then the response will come with either lower interest rates or stimulus or yield curve control, whatever it is. And it's going to push energy higher. That's my logic there. Inflation is going to come back into the system. They're going to lower rates. There's going to be more bank lending. Sales volumes will go up. And then you'll see the energy sector take off again. because we have no inventory of homes. Here's a century of data that might help to identify generational opportunity. It's not on the buy side. Show your work doesn't just apply to math tests. So this guy says, any comment on Richard Bernstein's call last week for a generational buying opportunity? Right now in 11.3, we are basically the worst valued market in relationship to treasury bonds ever in the history of going back to 1928. We are the worst. Anywhere in this sector over here puts you in the worst area in terms of potential expected returns of the next, what is this? It was the next, so estimated 12-year S&P 500 total return in excess of treasury bonds, minus 7.4%. Now, here's the thing, and this is where this chart may even be wrong. They are completely right that this is the projected moves going forward based off of where treasury yields are and the pricing of the S&P 500, the value of it. But this Richard Bernstein may still be right, because I think what's going to happen is there's going to be some sort of scare. They're going to pump the system again. And when they pump the system, that is when the S&P could also go up with everything else. So it could still go up. I just don't think it will go up as fast as highly inflationary sensitive assets like oil, platinum, and other commodities. Josh Young says, U.S. natural gas production surged recently, pressuring prices and threatening oversupply despite the low rig count. I think gas production should start to decline as the low rig count impacts production with some lag, maybe not until early next year. So we can see in the lower 48 gas production, we've really jumped up the past few months in terms of production of natural gas. It is having an impact on pricing. We're also seeing warm weather having an impact on pricing as well. This guy wrote this, and I had to think about it, and I'm still thinking about it. It says, when would you consider yourself successful? I think there's multiple. I think that is dependent on your age. When you consider yourself successful, I would consider an 18-year-old highly successful if they move out of their house and are living by themselves. That is highly successful for their age. So I think it's all dependent and relative to someone's age. And it depends on what you deem to be successful, as successful as an open-ended, it's whatever someone deems to be successful. You could say self-reliance. You could say learning a specific skill. You could say having kids and raising really good kids could be very successful. There's so many things that you could measure that by, and I think it's all dependent on what you want to be successful in, period. So don't try to use other people's measurements of success and apply that to yourself. I think that's a really bad thing to do. I think what you need to do is measure your forms of success off of the goals and not really goals. Measure it against what you want to be successful in. That's all I'll say. Investors withdrew approximately $2.3 billion from tech funds over the last week, and largest outflow in 8 weeks in terms of tech. So that's kind of interesting too. Maybe this recession is kind of creeping around, getting people. I mean, we know people are worried. We had 50-some%. That's the 96th percentile. So that's way up there. We've got all these indicators that are saying that things are kind of crappy. And now we're seeing the largest outflow from tech. Kind of interesting. Mortgage rates are dropping after last week. Hit a 5-week low. Look how fast this dropped. 8.45 to 7.82. This here is within a span of when you lock in rates. That is crazy. It does look like to me, if you draw kind of just a rough trend line through here, that we've broken that trend to the downside. And if we are in a slowdown and we are in a recession, I would expect rates to go down, which means we could see the 30-year mortgage rate go down even further. That is debatable, and we're going to have to see and get more data behind us to see if this trend is really gonna keep going down. But it kind of looks like that to me in the short term. Japan's debt to GDP has crossed a staggering 220%. This is the highest level among all developed countries, and that is Japan's debt as percent of GDP. Went over 100, never looked back. I mean, we had a little slowdown here when we had a slowdown in the markets, but this thing is not looking too good. Mike Simonson says, is this the beginning of the end of the housing recession? And remember, I was talking about mortgage rates up here and all of the slowdown and bearishness in the market. He says, while home prices in the U.S. held up in 2023, home sales volumes cratered. Consumers care about home prices. The industry cares about transaction volume. For the industry, 2023 is in a deep housing recession. This is your inventory. It's still incredibly low in relationship to all the other years. We got to go way higher to get to a level that would be considered normal. So we're still incredibly low on inventory. This is our weekly new listings, really, really low. 62,000 new listings with 9,000 immediate sales, same as last year. That's still low. We've got weekly new contracts pending. I mean, look at that coming off a cliff here, guys. That's pretty low. And then we've got percent of properties with recent price reductions. There we are in 2023. Last year was 43.2% peak price cuts. So we're below last year, surprisingly. That is surprising to me, at least. Peter Schiff says, due to the weak economy and rising rates, the national debt is over 33.7 trillion, an increase of 700 billion in just over 6 weeks. At this pace, the national debt is growing in excess of $5 trillion per year, despite official deficit projections of under 2 trillion annually. 5 trillion a year, that is ridiculous. I mean, 5 trillion on 33, that's, that's about a sixth to the seventh of our entire debt in a single year. I hope we don't grow that much. That's getting kind of concerning. Maybe I should go buy more physical gold, right? This is what happens when high interest rates crushes demand-supply dynamics. U.S. homeowner vacancy rate is at a level never seen since 1960. Homeowner vacancy rate, that's really, really low since 1960. So, I mean, I find it hard to believe that if all these homes are, I guess, rented out or someone's occupying it, I don't see how we have, a housing surplus like some people are talking about. We have a housing shortage. And this is more information or more data describing that situation, at least in my opinion. Why is it so hard to buy a house today? I don't know. Maybe it's because housing prices increase faster than our incomes. Note, this is a picture I found in my phone, and I can't remember the source. I'm looking for it as we speak. This is the house price to income ratio is stretching to new extremes. Well, some people, they look at this and they say, well, I don't think I'm ever going to be able to buy a house. And when I look at it, I'm like, well, I better save a lot of money and get in a house as quickly as possible, because if this is the trend, I think it's just going to continue to get worse. I don't think it's going to get better. So I don't know. I mean, that's the way I think about it. And they're going to print more money, and it's going to drive up asset values, especially in nominal terms. So the price of everything goes up, but I don't think it's going to go back down, guys. That's my take. Renters making over 150K surged by 82%, far outpacing lower income categories. These are the people that can afford to buy. Housing is losing its appeal. It's too expensive. If I were in real estate, this trend would make me nervous. And, I don't know if the person who's talking about this, like, we don't know the data. We don't understand the data. So people over 150, and remember, this is the changes in the number of renter households. So this is a household. Well, if people are a millennial group and they've never owned a home, they're probably making more money as time goes on. So this category, if your affordability goes down, your renters are going to continue to rent, but they're also going to continue to make a lot more money. So I think that it's just people who are renting are continuing to rent, but they're making more money. That's the way that I kind of view this data. And I don't know what the actual reasoning is behind it, but I can see millennials. I know people who've rented when they first started working. They've been working for, they're 27 years old or something like that, 28, and they make over 100 grand, and their combined income might be 200, 250, and they still rent. It doesn't mean, they're looking for homes, they're trying to buy a house. They just don't like what they find. There's just not much to pick from. So if there's nothing to pick from, how do you buy a house? You basically are stuck with just new home builds if you don't like existing inventory of existing home builds. Gold versus the SPX. Are you really betting it's going to be different this time? If so, why? 1930, 1971, 2001, and 2023, it's starting to break down. And that's also why I think we're in 2001. All of the indicators are lining up in 2001. A lot of these ratios are lining up like 2001 or 1971, which means we're really, really early in this cycle of commodities. And the way that this thing's breaking down, this is crazy, guys. Someone had asked a question. They said, what if the commodity bull market doesn't occur or doesn't happen? And I just look at it and I'm like, every single piece of data I look at supports a commodity bull market and or supports buying it because of the valuation levels. It's rare in history to have that type of alignment where you've got incredibly good entry points for commodities and all the data supporting it. Here's something I wanted to point out. If you wanted to play the biggest bull markets in commodities, you had 1, 2, 3, 4 chances in history. You probably, if you're a baby boomer, only had 1, 2, 3 in their lifetime. Depending on when you were born, I may only have one option because I wasn't really old enough. I just graduated high school in '99. I was in college in 2001 myself, and these are such great opportunities here for the commodity bull market. Another thing that you can show, and I'll bring this up here, 1931, 1969, and 2022. 1931 is just over here. 69 was over here just before this breakout in 71. So 69 was the breakout down here. And then we got 2022, which is just before the breakout here. They all align in each of these major commodity bull markets. Outside of the one in 2001, we didn't have the same movement here, which is this is the increasing of the interest rates. Think of it that way, where it impacted overvalued bond market and stock market, and they both returned negative. This has occurred every single time in the beginning of a commodity bull market. So I know someone asked the question, what if this commodity bull market's not going to come? All I'm going to say is all of the evidence that I look at aligns with the commodity bull market that's going to come. It aligns with a gigantic bull market. The interest rates breaking out of its 40-year downtrend, stocks and bonds going negative. We've got the 100-year lows in commodities versus Dow Jones, which we've got this Dow Jones to gold breaking to the downside there. This is all kind of in alignment, guys. Even the PPI to CPI ratio is screaming that the producer price index is going to outperform the consumer price index, which is an inflationary environment. So all the data that I look at and find and see is supportive of a bull market. And guys, I've looked for contrary evidence everywhere I can. But nice chart there. Even Twitter's greatest housing bull can't believe how little inventory is building. The consumer knows the Fed will cut and ease conditions. When that is consensus, it neutralizes rate hikes in housing and forces the Fed to get stocks down. But not doing that anymore either. So he's talking about the growth rate being very slow for his taste in the housing this year. There will be an attack on the metals tomorrow. This was November 6th that he's talking about, which is yesterday. But I think by the end of the week, the cartel will lose the battle for $2,000 and silver will finally break through the 200-day moving average. That's his guess for Gary Savage. So that's kind of interesting there. Jared Dillon says, the yield curve inverted 16 months ago. 8 out of 8 times the yield curve inverts, we get a recession. The recession happens when the curve uninverts. The curve is uninverting. Payrolls are finally crapping out. A recession is inevitable. He says buy the 2-year yield, 2-year bond price or bond yield, however you want to say it, 2-year bonds. I don't know if it's 8 for 8. I think it's like 6 or 7 for 8, but there is a high probability that we already are in a recession, and that's what that other information is talking about above. The bar is historically low here for existing homes, so it won't take much to bounce from these levels as we did last year. However, it does need the 10-year yield to go lower and stay lower with duration if we want to bounce in existing home sales. And I agree with that. That's where your volume comes from. So that's what I've got for today, guys. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you guys like. We do have a 7 a.m. Mountain Standard Time question and answer session coming up this weekend. If you want to ask questions, I know I think my daughter has something this weekend. I'll have to look. I want to make sure that we got that big block put out there. But that's all I've got for today, guys. Everything that I see is still good for commodities. We could very well have a slowdown or recession out there in the markets. We could definitely see that over the next, from now to whatever. And then we'll see what the Fed does. We'll see if they lower interest rates or if they do something that's stimulative, whatever it is. And then we'll see it and we'll go back up with another inflationary impulse move. And the timing of it, I don't know. That's everyone's guess. Everyone wants to know that information. But that's all we got. We'll catch you later. This is Finding Value.